This conference will now be recorded.
Okay, good morning, everybody. This is Matt. And we have an agenda, that we're going to try to get through, and we'll circle back to the resolutions if we, if and when Lonnie joins. Um, I think
Lonnie
first,
is joined.
Lonnie joined.
Yep, she just joined.
All right, great. Well, good morning, Lonnie. Then in that case,
Good morning.
good morning. In that case, I'm going to call the meeting to order. This is the October 15 meeting of the ACG committee. And we have Lonnie and Mike and myself as quorum. So let's jump right in because I know we only have booked an hour and we have to get through our CAFR, which is sitting at almost the bottom of the agenda. The first order of business is to just review the Board of Directors membership and attendance review. The second part of this is something we started doing, I don't know, 2 or 3 years ago, to just sort of give members a reminder if they are missing a number of meetings, and trying to keep attendance at a good level. So Brian, I'm going to rely on you, or if there's someone else who can walk us through the membership term update and the attendance review.
Sure, I could. This is Brian Farnan. I could do that. Yeah, and all the letters went out. That was kind of a nudge we wanted to do to board members to, just make sure. And again, and we totally get it, especially when meeting dates change. We're in this crazy world of COVID, and this is, at the end of the day, a volunteer position. So it's a balancing act for us. And we sent those letters out. When it comes to attendance, maybe a couple of board members we'd kind of like to see pick it up. But there's also good news too. The statement of financial interest. We've never had a missed date for those being filed, which I'm happy to report. I would also like to, this memo also raises that, our board composition. We have one vacancy right now for a finance position that we're actively looking to fill. And then when it comes to governance docs, we can hold off on that part of the review, which is also part of this memo, but we'll handle that as a separate item, and we'll just talk about that annual review. So, and just another way of background, people may notice that if their term expires, it doesn't mean that they are no longer a board member. This is something that there's statutory authority for, and I've actually surveyed other quasis, and basically you're in that position until either A, someone resigns, or B, another person is appointed in their place. I know that's been a question that's come up by others, like, hey, my term ends, on this date. Am I still on the board, or do I need to get a new letter? The reality is, so long as the appointing entity or person doesn't reappoint someone else, you can stay on until someone is appointed. So I'll just end it there because I know we've got a lot more to cover with the CAFR, unless there's questions.
No, I think that's good. I skipped, just circling back for a second, I did skip soliciting any public comments, so I'll just mention that here. Are there any public comments? Okay, hearing none, we'll check the box on that. All right, then the next item is the governance review documents. Brian, did you say you want to hold off on that and go right to the CAFR?
No, we could do the governance. We could do the governance review documents now. And the one thing, did we approve the minutes?
No, sorry. Let me back up to that agenda. So yes, we have the minutes of our May 19, 2020 meeting that are in the packet. So if everyone could take a look at those, and then I would accept a motion to adopt the minutes. Okay, would anybody, Mike or Lonnie, would you like to make a motion on the minutes?
I move adoption. This is Mike. I'll second.
Great. Okay. All those in favor? Aye.
Aye.
Opposed? Abstentions? Hearing
This
none?
is Mike. I'm going to abstain since I wasn't at this meeting, it looks like.
Okay. All right. Okay. So 2 ayes and 1 abstention, and the minutes are adopted. Okay. And then the next item is going to be, we're going to jump to item 5, which is the governance review documents.
All right, perfect. And we go one more slide. All right, excellent. So on an annual basis, what we do at the Green Bank is basically do something that it's kind of a healthy exercise. We go through and read these governance documents and say, hey, do we want to make any changes to them? And we were comfortable with all the documents. And the one thing I would just point out is that the bylaws were already revised this year. Those revisions came about based on a state auditor's document that was created based on a review of other quasi-publics, and they basically created those best practices. So that was probably the biggest change we've had to our bylaws in a few years. It did some simple things like adding the purpose and function of the Green Bank, but also gave us the flexibility to add a treasurer to the board of directors. It also added the oath right into the bylaws, which was helpful. And then we also had another requirement that basically that when it comes to like the ethics policy, it actually has to be countersigned. So, and then we also expanded the conflict of interest policy to include immediate family members. So these were all changes that were done this year in our bylaws. But beyond that, none of the other governance documents needed any revision. So unless anyone has any questions, we could move on from that.
Any questions, Mike or Lonnie?
None for me.
Okay, all right. Well, Brian, thank you for going through these. As you pointed out, it is in our bylaws, and so it's a good thing to peruse even for us members, although there's a lot of them. So thanks for putting it on the agenda. And then section B of item 5 is the reporting requirements. We could just get an update on where we stand with on all our reporting requirements.
Sure, and we're plugging ahead with those. A few years ago, this was something that was an audit compliance issue, and what we did is we created a statutory report checklist. So basically, we would have all these reporting requirements all in one place, and we track them. And I believe we're in pretty good shape. Jane, are we all set with any of the financial reporting requirements? That would have been the only area that sometimes from a resource issue, but I think we're all set there too.
Yeah, we're good with those since we worked with the state to change our reporting so that it can come directly out of Intact. So now it's easy.
Which
Okay.
was great. That was go ahead.
Yeah, and I was just going to say for Lonnie and Mike, if you didn't notice, there is that table that Brian's referring to is in the overall book. Now, it looks like we don't have it on the slide deck, but which shows where we stand on each thing. And I would say we seem to have, this seems to have really helped in addition to the change, Jane, that you're referring to. So, all right, well, good. So let's keep on track because this seems like easy pickings. When if we're late on them, it's just, it just shows up in our audit no matter what.
Nobody needs a Hartford Current article based on the lack of filing of 3, blah, blah, blah. So it's something that we just, we've been on top of, and Jade's team has been amazing with getting that revision done, which I think really helped from a resource perspective and streamline and for efficiencies.
Yeah, it is a lot of reporting though. I'll just note, we have a lot of reporting obligations. Someday it would be interesting to quantify it and see if we couldn't streamline them with the legislature.
Just on that note, this is Mike. I mean, are you guys going through the same exercise that the rest of the state government is to like identify all the reporting requirements that you have that you no longer think are relevant?
No, that has not come to us. That we haven't been provided that request.
Gotcha. Yeah. So, I'm not sure if you guys want to check on this, but, the governor hired Boston Consulting Group to help us plan for the 2020 retirements. or 2022 retirement, sorry. And so as part of that exercise, a lot of it is like, how can technology replace, retirement? And then one of the other parts is like, what are the things that are sort of outdated and obsolete that we no longer think that we need to do or should have to do anymore? And a lot of it is like reporting requirements, and we're like compiling a list. So, I mean, people can consider whether or not we can drop some of the things.
If you have a copy of that ask from the governor's office, send it our way, because we would take a look at it. That may be something that would be worthwhile for us and other classes to also consider from a streamlined perspective.
Yep.
Yeah, especially.
This is Lonnie. I just want to, and everybody probably knows this already, that Kevin Rennie is now joining Face the State. And so I really applaud how proficient everybody's being, dotting all the I's and crossing all the T's. But, there's going to be a lot of FOI, particularly with all, public-private entities. So just something else to keep an eye on.
We don't want his call.
Exactly.
Well, the good news is we're doing well. So, but yes, let's keep it that way. But I think let's maybe just maybe Jane or Brian, you guys can talk offline and think about what Mike just said. Because if there's going to be a bill for the other agencies, even if we're not asked to do it, it'd be good to have it handy and see if we could get it put in. And again, it might, not trying to not report, but we have a lot, and maybe some of them could be consolidated or done, every year instead of every quarter. Anyway, all right, let's move on to unless there's more comment, let's move on to the CAFR, because, that's the main protein dish here.
This is Jane. I'd like to introduce Ron Nosek, Jessica Aniskoff, and Dan Smith, who are our audit team this year on the financial side. And they've put together a presentation for you regarding their findings and a quick overview of where we stand this year. So I'll turn it over to either Jess or Ron. I'm not sure who's doing it.
I've got it. So
You've got it. Okay.
This is Ron Nosek from Bloom Shapiro. Thanks for having us. What we're going to go through here today is the reporting results of our audit for the fiscal year ended June 30, 2020. Some financial highlights, and then we'll go over the required communications from us, the auditors, to you, those charged with governance. It is not, this presentation is not meant to be down at a granular level. We're probably at 35,000 feet here. We'll certainly take on any questions that you may have now or down the road relative to the CAFR, but if you've got it in your custody, as in draft form, it's a pretty substantial document that there probably isn't enough time in a week to go through that page by page. So we'll move forward here. The first section we'll talk about, if we could jump a couple slides ahead, is going to be the reporting results. And these by far, I think, are the most significant things we could report to you. Relative to the CAFR itself, our reporting, which is performed under generally accepted auditing standards and under generally accepted governmental auditing standards, those reports are the only things that actually belong to us. The financial statements, and I think you all fully understand this, are management's financial statements, and we are simply there to audit and opine on those financial statements. Our opinion under generally accepted auditing standards is the primary opinion, page 1 of the CAFR document. And for June 30, we've issued or are going to be issuing an unmodified audit opinion on the financial statements, which simply states that, in our opinion, the financial statements fairly represent the financial position and results of operations of the bank for the fiscal year ended June 30, 2020. Under generally accepted governmental auditing standards, we're also required to gain an understanding of the internal controls relative to financial reporting at the bank and report to you if we uncover during that work any material weaknesses or significant deficiencies relative to that internal control. And we're also required to identify any compliance requirements that the bank may be under, that a violation thereof, in our opinion, would be deemed material to the financial statements. And in both of these cases, both of the criteria, again, we're required to issue what we call a standalone yellow book report relative to this. That report, when issued, is going to indicate that there were no material weaknesses or significant deficiencies that were identified relative to the internal control structure over financial reporting. And relative to compliance, there were no issues of non-compliance that were identified during the performance of our procedures. So all in all, top marks, if you will, relative to financial, our opinion and reporting relative to the financial statements. For some financial highlights, we can jump ahead a slide. What these are simply snapshots of, they're right out of your MD&A, and actually, as I said that before I go further, if again, I know it's an extremely cumbersome document. All governmental financial statements are, and what I suggest to any committee I meet with is if you read anything in those financial statements, take the time to read the management's discussion and analysis, which is anywhere from maybe 8 to 15 pages long. It's at the very front of the report, and it really discusses not what happened, but what happened, as opposed to something changed by $1 million or whatever the case may be. It gives some reasoning behind that, so it provides some clarity and some commentary relative to the financial statements rather than just looking at numbers from a comparative perspective. But so what we're looking at right now, the snapshot on the screen, is the assets and deferred outflows of resources as of June 30, 2020. And total assets of the Green Bank increased to $213 million during fiscal year. That was an increase of about $2.3 million. Your program loans increased by $17.1 million. Those were increases in the low and moderate income lending. You had an increase of $5 million over your commercial solar PV asset and some sale PV asset sale financing of. I'm sorry, I'm jumping backwards here. The program loans increased by 17.1. Your commercial solar PV sale financing had an increase of about 4.1, and your multifamily lending of 2.7. All of those increases in assets were offset by a decrease in cash and cash equivalents, which was driven by disbursements to contractors for the construction of the CSCU solar PV systems. And overall, current assets decreased by 9.1 million, while current non-current assets increased by about 11.4. We'll talk in a second just what that did to the liquidity position of the balance sheet, but still in good shape, but it did decrease the liquidity position of the balance sheet a little bit. If we jump to the next slide, what we're looking at here are the liabilities and deferred inflows. And as you see here, relative to variance, total liabilities increased 1.9 million during the fiscal year. And that was primarily due to your line of credit that you entered into, about 6.1 million, as well as your increase in OPEB liability, which is getting pushed down to you from the state of Connecticut. And those were actually offset by some decreases in long-term debt. So while clearly the 1.9, the 6.1, I should say 6.1 and the 4.5 jumped well ahead of 1.9 million. That decrease in long-term debt drove that overall increase down. Total net position of the bank as of June 30, 2020 was $76.7 million, which was quite consistent with the prior year. It increased $460,000. I'm sure you all remember quite well, last year we had the sweep from the state of Connecticut, which created quite a depletion of net position. So that did stabilize here in 2020. And then as I just spoke to, the liquidity of the balance sheet. So current assets divided by current liabilities decreased from 192% to about 110%. Depending on industry and where you are, as long as you're over 100%, you're considered to be in a viable position. 200% is considered to be very strong, but I think the change in that is going to be a recoverable change if it hasn't already, simply because it was all relative to some cash flow activity and during the fiscal year. Jump ahead to the next slide. We're going to be looking at the statement of changes in net position. And again, just pretty high level here. You had operating revenues of approximately $53 million for the year. That was an increase from the prior year of about $7.5 million. And it was mainly due to an increase in rec sales of 2.8, RGGI auctions, revenue of about 2.5. These are increases in the sale of energy systems of about 1.2. Your total operating expenses increased approximately $5 million during 2020, and that was due mainly to the increase in pension and OPEB expense of 1.4 million and an increase in the provision for losses of 2.8. So one of the two of those, actually two of the three of those, as you well know, are really not under your control. The state is having the actuarial valuation of those plans, and again, those liabilities get pushed down to you for financial reporting purposes. If you can jump ahead another slide. Same slide off to your right there, same snapshot, but what we're looking at here is just your non-operating revenues and expenses, which were approximately 3.9 million net expense for fiscal 20. It was 17 million last year, but as I stated earlier, you had that significant sweep of $14 million last year from the state of Connecticut, which is really what drove the swing. So that will again, 40,000 foot review relative to the financial statements and basically your variances that went on during there. So we can jump to the next slide, and what I want to go through is the required communications to those charged with governance. So these are topical areas that we are required under auditing standards to report to to those charged with governance, and through them you will receive a formal letter when the financial statements are issued. But it is important to go through these with you, and from an overall perspective, really what the whole design of this required communication is an opportunity for us to provide you information that would be relevant to our feelings and thoughts if management was indicating or showing any bias relative to the financial statements. And by bias, it would mean trying to make them perhaps look better than they actually are, or perhaps look worse than they actually are. That's the point of this. So first and foremost, we're required to report to you about qualitative aspects of the accounting practices. So this really encompasses the selection of generally accepted accounting principles and the implementation of those principles, as well as the use of estimates in the financial statements. If management is going to show any level of bias relative to the financial statements, where it is going to arise is within your estimates, because they are just that, estimates. They are easy to be manipulated, one being reserve, loss reserve. So, clearly there's no empirical evidence we can look at as auditors. We've got to look at estimates a little bit differently. And if we thought that they were getting weighted too heavy or too light, that would be something we report to you. So relative to what transpired in 2020, As the statement says here, management is responsible for the selection and use of appropriate accounting policies. During the performance of our audit, we did not note any transactions entered into by the Green Bank during the fiscal year for which there was a lack of authoritative guidance or consensus. So there was nothing, a one-off or anything out of the ordinary that we had to evaluate outside of the scope of generally accepted accounting principles. And based on the work we performed, all significant transactions have been recognized in the financial statements in the proper period. So that's relative to cutoff, where again we would report to you if management was trying to back things into the fiscal year or push things forward into the next fiscal year. The next slide continues on with qualitative aspects. This is about the estimates. The statement here, estimates are an integral part of the financial statements prepared by management and are based on management's knowledge and experience about past and current events and assumptions about future events. What we provide to you here are, in our opinion, the most significant and sensitive estimates that are embedded in the financial statements. And those are the loan loss reserves, the fair value calculation relative to your swap transactions, the net pension and OPEB liability, and your asset retirement obligations. I won't read through those. I think you all are well aware of what those are. And then the next slide, what we're indicating to you is, what did we do relative to these? So we evaluate the key factors and assumptions used to develop the sensitive estimates in determining that they are reasonable in relation to the financial statements taken as a whole. And in some instances, relative like to your OPEB and pension liabilities, we're relying on a third-party expert. We're relying on that actuarial firm that is doing the calculation. In the other cases, we're comparing this information both statistically relative to the underlying asset or liability that is generating the estimate, as well as comparing it to multiple years, both just side by side and relative to the percentage estimate or the percentage calculations we're doing relative to the estimate. So that's basically the reasonableness work that we're doing relative to that estimate. And then finally, the financial statement disclosures, in our opinion, are neutral, consistent, and clear. There were no sensitive disclosures affecting the financial statements. Again, clearly, if there were sensitive disclosures, we would bring those to your attention in this communication. So next slide, we would be required to report to you if there were any difficulties encountered in performing the audit. And these would be, issues where maybe management was not providing us information we were requesting, or they kept moving the timing of when information was going to be available to us, or if the timelines that they were placing on us were unreasonable. All of that we would be required to report to you relative to that, so that you can make a determination if there's something that you would need to do. But in the case of the audit, in the history of our experience with the Green Bank, and this year as well, we encountered no significant difficulties in dealing with management in performing and completing the audit. Corrected and uncorrected misstatements, we're required to report to you any corrected or uncorrected misstatements, generally that are material to the financial statements. Again, for you to evaluate and determine, okay, why are we encountering misstatements, if you will, that management missed or perhaps misinterpreted something or something to that nature. But again, we'd be required to report them to you for your evaluation related to management. But in this case, in the audit of 2020, there were no uncorrected misstatements that were identified in connection with our audit of financial statements for the fiscal year ended 2020. So there is nothing to report to you relative to that. Next slide, we'd be required to report to you any disagreements with management and what these generally apply to would be GAAP and gas things. So if we had a disagreement relative to the application of generally accepted accounting principles, or if we had disagreement with management relative to certain procedures that we felt were necessary to perform over the financial records as part of our audit engagement, we would be required to report those to you. And again, as consistent as it's been over our time with the bank, we encountered no significant difficulties in dealing with management in performing and completing the audit. Relative to management representations, we have not obtained them as of yet. Those basically are the last piece of evidential matter that we will obtain, but we will obtain management representations from management just prior to issuance, final issuance of the financial statements. Those are pretty comprehensive in nature. I think the rep letter is probably about 4 or 5 pages long. It changes from year to year relative to what's going on, but there are some standard representations in there as well. Management will have a copy of that subsequent to the issuance. So if any of the board members care to look at it, they can inquire with management, or you could inquire with us and we could send it along. Jump ahead here. Management consultations with other independent accountants. We would be required to report to you if we were aware that management reached out to another audit firm or accounting firm, primarily due to the fact that they did not agree with us on a certain matter. So oftentimes this is referred to as gaining a second opinion, or in worst case scenario, opinion shopping. But again, as has been consistent to our knowledge, no such consultations occurred. And then what we do report to you is audit discussions related to GAAP and gas and other matters that we have with management on a regular basis. And if any of them, in our opinion, were odd or gave us pause, we would report those to you. But in our opinion, relative to the audit of 2020, any such discussions that did occur took place in the normal course of our professional relationship, and our responses were not a condition on our retention. So management, isn't holding anything over our head to make a decision one way or another. And then finally, other matters, and this is just letting you know with respect to supplementary information, and this is all spelled out in the audit opinion itself. But in regards to supplementary information, this basically gives you a general idea as to what we're doing with that information relative to the audit. So in certain circumstances, supplementary information in particular, we're comparing it to the audited records. So we are taking some responsibility for that information. There is, and again, identified in the opinion, there is other information in that CAFR that we are not taking any type of responsibility for. The statistical information and things of that nature, we do not issue an opinion on those. We do look at them to make sure that they're comparable and line up with the audited section of the financial statements. But we're not going into a deep dive there. Whereas with the supplementary information, we do tie that back directly to the audited records. And then second to last slide is just standard communication, that the information in this slide deck and in the letter, formal letter that will be issued, is intended solely for you, okay? The audit compliance and governance committee and management of the Green Bank. It's not intended and should not be used by anyone other than those specified parties. What you do with it internally is up to you. We're simply explaining to you that it's only meant to be communications between the two of us. Finally, as always, just want to thank the staff at the Green Bank that we work with relative to the audit. We truly enjoy the relationship that we have. It's been a very, very good professional relationship, and we're happy to be your auditors. And that'll be it. The last slide actually is just some identification, our contact information relative to the audit team that was announced earlier. As always, you can reach out directly to us. It generally is more efficient to work through management to get to us, but nonetheless, if you call us directly or email us directly, we'll pick up the phone and respond to the email. So that's all I was going to cover today. Again, the team is on the line here. We'll take any questions that you may have at this point. And again, I know we've got another meeting next Friday. And even beyond that, if there is a desire to have a meeting with us to talk about matters that are in the CAFR to get further clarification, we're more than happy to do that. So I'll turn it back to whomever is going to take control.
All right, this is Matt. Well, thank you, Ron and Jessica and Dan. It is always nice to get an unmodified report, and thanks, Jane and the management team. It does seem like, as you guys as collectively all have this really running smoothly for the audit, and it's nice to hear that. Before we open up to questions, I guess I would just say, typically, and I may have missed it, Ron, but I think we always say to the commission, the members of the committee, that if you have any concerns or want to talk offline with the auditors, you're encouraged to do so, calling them directly if it's something that you want to do.
That's absolutely correct, and especially if there are concerns, directly relative to management, but most certainly, we're here. We work for you, the board. We work with management, so we're certainly here at your beck and call.
All right, thank you. So why don't we open it up to any questions from Mike or Lonnie?
This is Mike. I don't think I have any questions, but maybe, just so I understand it right, you sort of like make a representation based on what you can tell, but there are limitations to all the information that you have. So, right, because I guess it makes me think about this like Berkshire Hathaway article I was just reading about how they bought this company and all their financial statements were inaccurate essentially, and even a giant company like Berkshire still bought this other company and couldn't see through sort of like the financial statements of the company that they bought, and they ended up buying this company that was essentially a big loser. Is that fair to say that there, I think that's what you were saying, all these caveats about what you can and cannot tell?
Well, under generally accepted auditing standards, we're required to plan and perform our engagement in a manner that would detect any material misstatement to the financial statement. So we're responsible for that to that level. If Berkshire bought a company that tanked, and they bought it based off of analysis they were doing on those financial statements, I would suggest to you that audit firm failed in complying with generally accepted auditing standards. But
I think it was more that the management misrepresented the financials to the audit firm, but the audit firm could not tease through that, is my interpretation.
Yeah,
but I think I understand what you're saying.
Okay.
Okay. Lonnie, any questions?
No, I thought this was one of the the best audit presentations I've heard. So no, I think it was very well done in it, and I'm very proud that management has really been transparent and working with the auditors as well. So that's all good news.
Yeah, no, I agree. It's I think we as a Green Bank and Ron and your team, it's have done a good job of trying to be transparent and going the extra mile. So I had a question. I just a clarification, I guess. So on slide, I think it was 6 or 5, you had indicated there was a decrease in our currently available, or really our cash position, of about I can't remember, it was $9 million or $10 million. And that in turn affected our liquidity, down to from 192% down to 110. I'm not a financial person, so what does that mean? I mean, was there a sort of, is 110% sort of a range we should be concerned about? I know you indicated that there was no reason to think it wouldn't bounce back up, but is there a sort of a line at which, a liquidity line at which there's a sort of a yellow zone? And two, was there anything I tried to find them in the management statement where the cash drop came from, but I couldn't.
Yeah, so from the perspective of the liquidity, if that that calculation was below 100%, we would bring it to your attention. If it's below 100% and a year later it continues to dip, clearly then at that point in time, depending on how much that dip was, we may, as auditors, find ourselves doing a going concern evaluation. That doesn't mean we'd be issuing a going concern opinion, but that's basically, that liquidity is one of the primary triggers that would cause any audit firm to start looking or considering going concern. Now, we're in a unique environment in the sense that the state, you're a component unit to the state of Connecticut, and so that would certainly come into the evaluation if we were ever to get there. But as long as you're over 100%, there's really no concerns. As a matter of fact, last year at 190, and I forget, but I could get that information out relative to what it was perhaps a year prior to that. I think the bank was pretty much off the charts relative to its liquidity position, and perhaps now, especially because of that $14 million sweep last year, maybe down to earth a little bit, at the current period. But if we looked at, well, I don't have it in front of me, but if you do have the draft, the cash flow statement, so it's going to be that third statement that's in the draft financials, that is going to give you a far more granular picture as to basically what transpired, what took cash from point A to point B. I'm trying to see if I can flip through my computer files here to get to that, but
that's all right, Ron. I think the first part of the question is really the other. I mean, we can talk internally. I'm sure our team knows where that, could explain it. So I don't want to put you to finding it. I can.
Hey, Matt, this is Brian. Maybe just offer one macro observation that's consistent with our sustainability plan that we focused on in December of 2017. Mm-hmm. So you can see here the program loans increasing by 17 million over the fiscal year to year. So our strategy is to move from current assets to non-current assets so that we're generating interest income that comes into our current asset growth, so that over time our interest income from our investments covers our operating expenses. That was our going principle on our sustainability plan, and we're making really good progress on it. So again, trying to address the swing that hit us in 2018 and 2019 by investing the resources we have in interest producing assets. So that's a large part of the story.
Okay.
And this is Bert Hunter, Chief Investment Officer. So another part of the strategy, Matt, is also that we have lines of credit that are secured by various assets. So with our Shreks and with certain other non-current assets that we've obtained lines of credit that the board has previously approved. So as of the end of the last fiscal year, June 30th of 2020, Jane, I believe we had approximately $13 million of availability under those lines of credit. I believe we had approximately $8 million available to us on the Shrek line, and we also had, I think, $4.5 million available on the amalgamated short-term line of credit. So, in addition to the cash resources you see there, we're able to, as Brian said, remain more fully invested, because if we do need some short-term access to liquidity, bearing in mind that we have our system benefit charge, which rolls in monthly, we have access to short-term liquidity lines of credit that we can avail ourselves of.
Okay. All right. No, that's helpful. I see that you know, we don't want to have a pile of cash laying around either. I just wondered if it was a particular expense that we used those funds for. All right.
Just to add real quick, and I won't take much of your time, but I did track down the cash flow statement. So when you have time, the section under cash flows from investing activities, the last two lines under that section are the program loan disbursements that were discussed just a few minutes ago. And those are close to $20 million of investment that would be cash going out. But as was indicated by someone earlier, you know, it's going to be returning with a premium included with that return being the interest component of it.
Okay. So we basically put that money to work, is what it sounds like.
Yeah.
That's right, Matt.
Okay. Thank you. Sorry to take up time. Any other questions? Okay. I think then thanks, Ron, and your team again for the report, and thanks, Jane, and your team for all the hard work as well. And Brian, sorry, do we have a motion on this? Do we make a recommendation or?
Yes, there would be a recommendation to the full board.
Okay, can we put that up?
It's resolution number 2, Matt.
Okay, thanks.
Yeah. I can read it if you like.
Yeah, that would be great. Thank you. Just the resolution part, not all the preamble.
Okay. Oh, and now actually, can someone? Now I'm knocked off the web, so it's not pulling up. Brian or Jane, do you want to read it until I?
Yeah. This is Brian. Resolved that the Audit, Compliance, and Governance Committee hereby recommends to the Board of Directors for approval the proposed draft Comprehensive Annual Financial Report, CAFR, for the fiscal year ending June 30th, 2020.
Great. I would accept the motion if someone wants to make it.
So moved.
And a second? Second. Thanks, Mike. Thanks, Lonnie. All those in favor, say aye. Aye.
Aye.
Aye.
Opposed? Abstentions? Hearing none, the resolution passes, and thank you, everybody. Okay, so we're getting close to our 9:30, so why don't we move right into the evaluation framework presentation?
Great. Eric, do you want to take this, or Carl?
We do have one resolution on this too, just as a heads up to everyone.
Yeah, all right, I'll move quick enough so that we have time to vote on the resolution. So as you all are aware, we have established methodologies that help us quantify our impact or estimate our impact in specific areas. We started originally with the job study working with DECD and Navigant, who are now Guidehouse, that helped us estimate the jobs created by the activities that are associated with our projects and our investment. That was approved initially back in 2011, I believe, and then refreshed in 2016. We have a tax methodology. We have other methodologies that this committee has reviewed and endorsed for the board. around environmental impact, which involves us leveraging models built by EPA for public health. Again, we're using an EPA model. For both of those, we worked with the state government to get their buy-in that these work well locally. So DEEP and DPH respectively endorsed those. We're coming to you now with a methodology that helps us shape our story around energy savings and what that actually means in dollar terms. So how much we're reducing the energy burden for the end customers who are participating in our programs. So next slide. So ultimately what we want to do is quantify the reduction to the energy burden. So how much money are we saving somebody by them having been part of our programs? And this methodology is something we've wanted to do for a long time. We've had the data available, but there was a lot to sift through. And Carl Johnson, who's our new asset manager, who just joined us, I believe it was March 13th. He joined the first day that we were in shutdown. Has been working on this and helping us codify our the methodology, make sure that what we wanted to do actually made sense. So basically our approach is to look at where we have insight into what the end customer is spending associated to the cost of their renewable energy, and what putting a value on what that energy would cost had they procured that from their traditional suppliers at the utility. And we're able to know exactly what energy we're talking about because we have insight into that generation through our Locus platform. So we have metering on that solar. And just to clarify, for this methodology, we're specifically talking about just solar. And we started out just looking at systems where the Green Bank has insight into what the expenses are for the cost on a regular basis for that solar energy. So that program-wise, that means anything that's in SL2 or SL3, or beyond, where we have insight into what those payments are for the power that's being purchased. SL2, SL1, and Posigen, because we know the lease payments on Posigen and SL2, and we know the loan payments on Solar Loan 1. We are still working on how we would do this outside of those programs where we don't have specific insight into that monthly payment. But we expect us to come back at some point with a methodology that expands on this. And the reason that we have all this information is we've spent the better part of the past couple of years building out a great platform for all of our data in our data warehouse. So next slide. So ultimately, our approach is to value this power that's being produced by the system locally, based off of what it would have cost had they procured it somewhere else. So Carl did amazing work sifting through Pura dockets to understand what rates were historically going back to when these programs launched, and logging that all into our data warehouse and creating something that we could use exactly for this. So we're taking, basically you took all sorts of documentation, went to something that was totally qualitative and something that's totally quantitative, and can just apply the value to this power. So next slide. Let's see, our calculations are actually quite simple. So we're taking the solar generation and then we're applying a rate. For commercial, there we're just applying what the difference is between the utility rate and what the customer's paying on the PPA, and that's the value of the savings. For Posigen and SL1 and SL2, we know what the power that's being generated. We're applying the utility rates that we're getting from Pura, and then we're subtracting out what their monthly expense is, so the lease payment or their loan payment. Straightforward. We've taken this and we've vetted this with Pura and with DEEP and have their buy-in, and I think they were relatively impressed at Carl's thoroughness and his ability to sort through the Pura dockets to distill this information. So ultimately what we would like you to do is review this and I think the resolution is asking for your recommendation to the board to approve this as our official methodology for quantifying energy burden reductions with regard to these programs. And we'll start to use this in our impact reporting in things such as the CAFRA non-financial statistics, or in our green bond reporting, or other things going forward.
Okay, thanks, Eric. Any questions, comments from Mike and Lonnie?
So does this ultimately lead to a dollar value?
It does ultimately lead to a dollar value. So if we, just taking here, go back to the commercial, or the next slide, sorry. The commercial savings. If we had, let's say, a project generated 100 kWh in a month, the difference between the utility rate and the PPA rate, let's say, is 2 cents. 2 cents a kilowatt hour. It's a pure multiplication, so 2 cents times the 100 kWh is with 20 cents that they've saved. Ideally, it's going to be more than that, but bear with my bad example.
Gotcha. Okay. I guess I'm a little hung up on the sort of like use of the term energy burden, because, you know, from my, like everything that I see, energy burden is usually a percentage of income.
Right. So we don't have any insight into what every family is making. So we can say, look, on average, we've reduced somebody's energy burden by X amount of dollars. And we know what averages are in specific areas. And we can talk about, hey, the typical family in this census tract, here's the area mean income, and our projects have been reducing by this amount. Assuming the area mean income across the board, the average family here has saved X. So we can get back to that percentage by through some extrapolation.
Yeah, Eric, to Mike's point, maybe just a chart that uses 60, 80, 100, 120% of AMI, and has that. That's a pretty simple chart.
Yeah.
I have a concern, I guess. I wonder if these equations aren't too simple. You know, it seems like there's other savings, secondary savings that may be hidden in our solar installs. You know, capacity charges. You know, we require energy efficiency upgrades, so there's reductions in consumption. You know, it seems like we're leaving some of that on the table. I like the simplicity of it, and we won't get accused of, you know, coming up with, you know, hedonistic values. But I just wonder if this is going to be our official methodology. I think we need to explain why. Go ahead.
I 100% agree with you, Matt. I would love to have something that captures all that. We went down the road of looking at some of that. It's not that easy and straightforward to quantify. So things like the demand charges and reduction in demand charges, or is that being offset by new demand charges for standby? It wasn't a straightforward way to do this. I think we're best when we caveat this by saying this is a minimal estimation. We expect more due to changes in demand charges, or due to the HES program that we were required the participants in Oxygen SL1 and SL2 to partake in. The HES program saves on average, I don't remember the number off the top of my head, but we can include that. But specifically going back to just the pure solar and the value of where they're procuring that power, I think this is a good estimation of that.
All right, well, we're a little over the hour, so I don't want to assume everyone can stay on. I guess I would just, that's my concern, and that once we put this number out there, we're kind of stuck with it a little. So I would like to see some heavy, you know, other language around it, that there are other values, but we were conservative or something like that. Mike, Lonnie, any other comments? Do we want to vote on this resolution, or are people, you know, it basically would be adopted. The resolution would be that we're adopting this methodology as our, we're recommending to the board that the proposed methodology and the fact sheet. So we'll get to see it again at the board level. So do we want to move that motion?
So I would say I think I need more time, but I'm fine if you all want to vote.
Well, it's up to.
I'm ready to move it. I mean, I think, this has always been a very elusive, these data points have always been very elusive. And as a legislator and a committee chair trying to sell it to fellow legislators, I mean, it was always, well, wait a minute, how much? How much?
Yeah.
So I think it's probably going to be a living, ongoing process, but I think it's very important that we begin to pursue this in more detail. And if we're working with DEEP and PURA, I think that's going to be helpful as well. So I would move to adopt it.
Okay, I'll second. And Mike, I understand. I kind of agree, but remember, we'll get a chance to comment at the board meetings.
Yep.
Motion is moved and seconded. So all those in favor say aye. Aye.
Aye.
And opposed? Abstentions? Okay. Mike, one abstention. Okay, so the recommendation resolution passes, and we'll thank you, Carl and Eric and everyone who worked on it. And I know, Matt, you're always the last guy here, so why don't I say this? There's no resolution. I'm going to stay on. I'd like to hear the update, but if anybody has to jump off because we're over time, feel free to do so, and I'll turn it over to Matt.
If we don't have Matt, I could do this. And with the
Brian, you might be primed to do it faster. How about that?
All right. I'll do it really quick with the caveat that I no longer have legislative responsibilities at the Green Bank. So obviously, with the two major storms that we had, and the delay in response, or it's perceived delayed in responses by both Eversource and UI, Eversource in particular, there was a strong political push before the elections to get some type of utility accountability bill passed. This was something that created additional flexibility for PURA, for example, in their rate review process, to give them more time, additional time to review those. I think in the past they would kind of run out of time before they had to, potentially opine, and then if that time ran out, then the bill would get passed. There also is additional, I would say, sticks and carrots, to use a word from our old chairperson, Catherine Smith, included in the bill. And then service outages over 96 hours result in monetary customer compensation. I think my personal opinion on this, the intent of this bill is good, in the sense that you're trying to hold your utilities to a higher standard. I think the continued problem with this legislation is that when fines and additional penalties are applied, I don't know if we have a regulatory regime in place that can ensure that those costs are not going to be passed back to the ratepayer. So at the end of the day, people want to kind of like get at the utilities for when a mistake is made, and they don't want that. They want it to come out of profit margin. They don't want that to be added to ratepayer cost. The reality is, now I think this is going to provide the utilities the ability to basically say, hey, if you want us to meet all these standards, we need to do X, Y, and Z. And that's going to cost additional funding, and that funding is going to come from the ratepayer. So in the long term, this will probably lead to increased ratepayer costs, but this will hopefully address some of the perceived or real misgivings that we've seen in the utilities. Any questions? Or Matt, I'll turn it over to you if anyone has any questions.
No, I don't have any questions. Lonnie, Mike?
I guess
I don't.
I wouldn't want to talk over the chair.
Go ahead, Lonnie. Why don't you go first, and then Mike?
No, I said I don't have any questions. I'm muting myself.
Mike, go ahead.
Yep, no questions here.
Okay,
Yeah,
great.
if I was Mike, I wouldn't touch this one.
All right. Well, thanks everybody for staying on, and thanks for that update. You know, this is obviously an important issue to ratepayers and to us. I guess if there's no other business, Brian or anyone else, Bert, you guys, anybody want to make a comment before we adjourn?
Good here.
All set.
All right. Thanks everybody for making time, and see you at the board meeting, and have a good day. Oh, we need a motion to adjourn.
So moved.
Okay. Second. All those in favor? Aye. Aye.
Aye.
Opposed? Abstentions? Hearing none. We're adjourned. Thanks, everybody.
Everyone have a great day.
This conference will now be recorded.